So today we are looking at another topic. This is a topic audit related assurance services. Audit related assurance services. So this will be topic 9. Though as per syllabus, the topic 6. It could be other topic. Yes, this should be topic 8. This should be on topic 8. Topic 8, audit related assurance services. So the key learning outcome areas of this topic are things to do with the prospective financial information, investigations and due diligence, special audit assignments like social and environmental audit, operations and internal audit management. Then the last one, we shall be looking at integrated reporting, and the audit of performance information. So those are some of the key learning outcomes in a topic topic 8 on audit related assurance services. So there is a handout which I think I also shared with you. So I want to go through that handout to discuss these areas. Maybe the next 1 hour will be done with this topic if it will be possible. This is our second last chapter. So let me also do the screen sharing from my end. So there we go. I think that's it. So we begin with the prospective financial information. There are certain basic terms that we should be conversant with, being able to understand the difference between prospective financial information and what you call a projection and a forecast. What's the difference between a projection and a forecast? For sound business management, it requires that managers should be able to do certain financial projection. The time frame for those projections may vary. One can be less than a year. Another one can be between 2 to 3 years. So whenever the managers does the projections of their business financial performance in terms of the cash flows, operations. Now, if it's less than 1 year, that's a forecast. If it's between 2 to 3 years, it becomes now a projection. For that case, such kind of information being reviewed by the auditor, it can be either prospective financial information or the forecast financial information. And certain assumptions are normally made in that particular context. So let's now begin by these basic terms here. So one is the forecast. So a financial forecast consists of prospective financial statements that present to the best of the responsible parties and knowledge and belief an entity's expected financial position, results of operations, and cash flows. The next term is a projection. A financial projection consists of prospective financial statements that present given one or more hypothetical assumptions, an entity's expected financial position, results of the operations, and the cash flows. A financial projection is sometimes prepared to present one or more hypothetical courses of action for evaluation as in response to what if a scenario. So what are the key differences between a forecast and a projection? What's the key differences between a forecast and a projection? So in a forecast, the assumption represents the company's expectation of actual future events. As in a forecast, the assumptions represent the company's expectation of actual future events. Then a projection is used when the assumption desired are not those believed to be most likely, essentially the what if scenario, the what if scenario. Then you have the definition for the term prospective financial information, the PFI in short. Financial information based on assumptions about events that may occur in the future and possible actions by an entity. Assumptions about future events can be in the form of a forecast or a projection or a combination of both assumptions for probable future events are highly subjective in nature and can vary from a situation to a situation. Then you have a forecast, which means a PFI prepared on the basis of the assumption as to the future events which the management expects to take place and the action the management expects to take as part of the date of the information is prepared. So best estimation assumption. The next one you have a projection, means prospective financial information prepared on the basis of one, hypothetical assumption about future events and management actions which are not necessarily expected, e.g. entities in a startup are faced or considering a major change in the nature of operations, or a mixture of the best estimate and hypothetical assumption. A forecast is usually made for a period a forecast is usually made for a period of not more than 1 year. A forecast is usually made for a period of not more than 1 year. Unlike a forecast, a projection is made generally for a period of more than 1 year. Usually, it's made for the period ranging from 2 to, it should be 2 to 3 years, 2 to 3 years. There are two other terms commonly associated with the PFI. So one, hypothetical illustration. PFI is based on assumption about uncertain future events and management actions which have not yet been decided on. Target, PFI based on assumption about the future performance of the entity. The listed company should have a procedures that allow them generate reliable PFI, compare it to market expectation, publish it when necessary, and subsequently report actual performance against it. Prospective financial information can include financial statements or one or more elements of financial statements and may be prepared, one, as an internal management tool, for example, to assist in evaluating a possible capital investment, or B, for distribution to third parties in, for example, one, a prospectus to provide potential investors with information about future expectation, and two, an annual report. An annual report to provide information to shareholders, regulatory bodies, and other interested parties. The next, a document for the information of lenders, which may include For example, cash flow forecast. So we have the matters there to consider before accepting the assignment. So this is a part of what you call the review engagement, which are guided by the assurance engagement standards, 3,000 assurance engagement standards, 3,000. So ask the practitioner before you accept to do a review of this particular work of either prospective or forecast financial informations. There are things that you need to take into consideration. So the matters to consider before accepting the assignment: one, the exact component of the prospective financial information. Is it maybe the cash flow statement? Is it maybe the income statement? Is it maybe the balance sheet statement? You should be able to consider that which component are they going to use as part of that, as part of the preparation of the prospective financial information. The other one is the form of the assurance report that is required. Now here we have got two assurance that can be provided, either reasonable assurance or the limited assurance. However, when it comes to this kind of engagement, the practitioner is expected to provide limited assurance with a negative opinion. A review engagement is a limited assurance engagement. So at the end of it, a negative opinion shall be provided, where the practitioner will be stating in his report that nothing has come to their attention to cause them to believe that the subject matter is materially misstated. So they form the assurance report that is required in an assurance engagement. The nature, the wording of the expected opinion should be discussed. These are the matters that we covered in our topic 1 and assurance and non-assurance engagement. Then also the intended recipient of the report, that also needs to be considered for the participant to receive that particular report. Is it maybe a lending financial institution, like in the case of the cash flow review, then the limited liability, if applicable, deadlines of the time frames are set, availability of evidence, professional regulation. A firm should discuss the kind of procedures that will be undertaken and confirm that they will be complying with the relevant professional guidelines. For example, the international standards on assurance engagement 3,000, assurance engagements other than audits or review of historical financial information, and international standards on assurance engagement 3,400, the examination of prospective financial information. The other one is engagement administration, like a fee, the person to be assigned to the assignment, complaints, procedures, etc. Then matters to consider and include in the term of engagement for prospective financial information. So some of these matters they will come across. So one is the management responsibility. So managers are the responsible parties. Their responsibilities must come very clear at the point of agreeing on what procedures to be undertaken. This is done to minimize any possible misunderstanding. So you have to clarify to the management what are their responsibility with regarding to the review of the prospective financial information. So the terms of the engagement should set out management responsibility for the preparation of the business plan and the forecast financial statements, including all assumptions used, and for providing the auditor with all the relevant information and the source data used in developing the assumption. This is to clarify the roles and reduce the scope for any misunderstanding. So the managers are the ones who are responsible to make assumptions, the hypothetical assumptions when it comes to preparing the prospective financial information, and they must ensure that they are reasonable. There should be some reasonable estimates in the process of doing so. Then the intended user of the report, for example, is it extended for external or for internal or external use? This will establish the potential liability to third parties and help to determine the need and extent of any liability disclaimer that may be considered necessary. So this can also be part of the agreed upon procedures. For that case, very important to identify who will be the recipient of the report. And the recipient of the report should be only those persons who agree on what procedures to be undertaken. And any party who was not there at the beginning, the point of agreeing on those particular procedures will not be allowed to use that particular report. They will be limited from using that particular report. Because if they're allowed to do so, they may do different, they may misinterpret the recommendations provided in such kind of a report. The other ones, the elements to be included in review and report. So the extent of the review should be agreed. For example, determine whether they are being asked to report just on the forecast, financial statements. This will help to determine the scope of the work involved and its complexity. The next, the period covered by the forecast. This should be confirmed when agreeing the terms of the engagement, as assumption becomes more speculative as the length of the period covered increases, making it more difficult to substantiate the acceptability of the figures and increase the risk of engagement. The other one is the nature of the assumption used. It is crucial to determine the nature of the assumptions, especially whether the assumptions are based on the best estimates or hypothetical. This is important because the A.A.A 3400, the examination of prospective financial information, said that the auditor should not accept or should withdraw from an engagement when the assumptions are clearly unrealistic, or when the auditor believes that prospective financial information will be inappropriate for its intended use. The last one, the planned contents of the assurance report. The engagement letter should confirm the planned elements of the report to be issued to avoid any misunderstanding with the management. In particular, it clarifies that the report will contain a statement of negative assurance, that's the limited assurance as to whether the assumption provide a reasonable basis for the prospective financial information, and an opinion as to whether the prospective financial information is properly prepared on the basis of the assumptions and is presented in accordance with the relevant financial reporting framework. So those are the matters that shall be covered in the engagement letter for this particular case of a review of prospective financial information in accordance with the International Standards on Assurance Engagement 3400. So next we go to the levels of assurance provided, And this case here, being that's a limited assurance engagement, a kind of a limited assurance engagement, the level of the assurance shall be a moderate assurance or negative or limited assurance. A negative or limited assurance. From topic one, you understand why that will be provided on assurance and non-assurance engagement. So prospective financial information is difficult to give assurance about because it's highly subjective, and this makes it a difficult area to examine and report on. Hence, the level of assurance provided is negative or limited, as opposed to external audits which examine historical financial information and where the assurance provided is reasonable or positive. Yes, in a topic one, tuliangalia the differences between reasonable assurance and also a limited assurance. The differences between the two. Your reasonable assurance allowed to go limited assurance. In terms of the level, these are high level assurance. Reasonable assurance is a high level assurance. Then limited assurance is a low level assurance. So reasonable assurance is expressed under the limit, sorry, it is expressed under reasonable assurance engagement. Reasonable assurance is normally expressed under reasonable assurance engagement, while limited assurance is normally expressed under what? Under the limited assurance engagement. And we say, for you to distinguish between reasonable assurance and limited assurance, you just need to have an understanding of what you call the engagement risk. Engagement risk, that's the first item, the first element of the two assurance engagement. Then the second one is being able to know about opinion. So the aim of reasonable assurance is to reduce an engagement risk to low acceptable level as the basis of expressing a positive opinion. For this case, a positive opinion shall be expressed. Positive opinion shall always be expressed by the practitioner. Then the aim of limited assurance engagement is to reduce engagement risk to low acceptable level, but always greater as compared to reasonable assurance engagement as the basis of drawing or forming a negative opinion. So there is a difference between a positive assurance and a negative assurance. Positive assurance is given under reasonable assurance engagement. The negative assurance is provided under a limited assurance engagement. So in positive, the rationale will be the standard ones in his report, the standard wordings in his report, the standard wordings in his assurance report. In his report, there is how they will be expressed in a positive assurance, a positive form, positive opinion. The standard wording shall be like, for example, in our opinion, the subject matter does not reflect a true and fair view. Or in our opinion, the subject matter does not reflect a true and fair view. Or in our opinion, the subject matter is materially misstated. Or in our opinion, the subject matter is not materially misstated. While in a negative opinion, the standard wordings in the assurance report shall be like this, that nothing has come to attention to cause us to believe that the subject matter is materially misstated, or nothing has come to attention to cause us to believe that the subject matter is materially misstated. So prospective assurance is a limited assurance, and for that case, a negative opinion shall be expressed by the practitioner. So guidance on reporting on it is given in A.A.A 3400, the examination prospective financial information. The A.A.A suggests that the auditor expressed an opinion, including one, a statement of negative assurance as to whether the assumptions provide a reasonable basis for the prospective financial information. Then number two, an opinion as to whether the prospective financial information is properly prepared on the basis of the assumption and relevant reporting framework. Then appropriate caveats as the achievability of the forecast. So those are the things that practitioner or the auditor will be confirming as they express their opinion. So due to the nature of the PFI, the audit firm will be unable to conclude on whether the results forecast will be achieved. Also, there may be insufficient evidence available to conclude that the assumptions are free from material misstatements. Therefore, the audit firm can generally only provide a limited level of assurance. The audit firm will normally provide negative assurance. This means they will state that nothing has come to their attention which causes them to believe that the assumptions are not a reasonable basis for the forecast. So then we have the examination procedures for things that auditors can do to collect sufficient appropriate evidence as the basis of expressing an opinion. So what can auditors do? What are the procedures that auditors shall perform when it comes to reviewing to examine prospective financial information. So one is the auditor should obtain sufficient appropriate evidence as to whether management assumptions on which the PFI is based are not unreasonable. Number two, the auditor should obtain sufficient knowledge of the business to be able to evaluate whether the assumptions are justified. Then three, the auditor should review whether the information is properly prepared on the basis of the assumptions. Four, the auditor should review whether the information is properly presented and all material assumptions are adequately disclosed. Next, the auditor should review whether the prospective financial information is prepared on a consistent basis with the historical financial statements using appropriate accounting policies. The historical information will be used as a yardstick to assess the assumptions underlying the information. The next, obtain backing as schedules for the information, cast and ensure they are numerically accurate, reperform calculations to confirm arithmetical accuracy of the forecast financial statements. The other one, obtain management representation with regard to completeness and accuracy of the information and assumption used. Also, they should contain a statement that it is the management's responsibility to produce the information. And next, identify and document internal controls over the process. Consider the role played by the internal auditor department. And next, consider the accuracy of the forecast prepared in prior periods by comparison with the actual results and discuss with the management the reasons for any significant variances. Next, perform analytical procedures to assess the reasonableness of the forecast financial statements. For example, finance charges should increase in line with additional finance being sought. Next, consider the reasonableness of the forecast trends in the light of the auditor's knowledge of the business and the current and the forecast economic situation and any other relevant external factors. And next, where the forecast under review is based on forecast regularly prepared for the purposes of the management, or whether it has been separately and specifically prepared for the immediate purpose. The next, where the forecast under review represents the management-based estimate of the results, which they reasonably believe can and will be achieved, rather than targets which the management have set as desirable. The next, the extent to which the profits are derived from activities having a proven and consistent trend, and those of the more irregular, volatile, or unproven nature. The next are how the forecast takes account of any material extraordinary items and prior year adjustments, their nature, and how they are presented. The next, whether adequate provision is made for foreseeable losses and contingency, and how the forecast takes account of factors which may cause it to be subject to a high degree of risk or which may invalidate the assumption. So those are some of the procedures that can be undertaken by the auditor in examining prospective financial information. So here are the specific matters to be taken into account at the point of the examination, the specific matters. So the following list of the procedures may also be relevant when assessing prospective financial information. The auditor should undertake the review procedures discussed above in addition to this. So one, profit forecast. Verify projected income figures to suitable evidence. This may involve comparison of the basis of projected income to similar existing projects in the firm. Review of current market prices for that product or service. Verify projected expenditure figures to suitable evidence. There's likely to be more evidence available about expenditure in form of quotation or estimates provided to the firm, current bills for the things such as services which can be used for reliably estimate, Market rate prices, for example, for advertising, interest rate assumption can be compared to the bank's current rates. Costs such as a depreciation should correspond with the relevant capital expenditure projections. Then you go to the capital expenditure forecast part. So what will you do as an auditor? The auditor should check the capital expenditure for reasonableness. For example, if the projection relates to buying land and developing it, it should include a sum for land. Projected costs should be verified to estimates and quotation where possible. The projections can be reviewed for reasonableness, including a comparison with prevailing market rates where such information is available, such as for the property. Then the other important area is the cash forecast. The auditor should review cash forecast to ensure the timings involved are reasonable. The auditor should check the cash forecast for consistency with any profit forecast. Income stock expenditure should be the same, just at different times. So that's the knowledge you need to have on prospective financial information, where projections and the forecast are involved in accordance with the international standards on assurance engagement. It's very important for you to know those terms, know the difference between a forecast and a projection. A forecast and a projection. Maybe just to summarize a few things there. There's a summary of a few things. A summary of a few things there. So let's have examples of PFI. Examples of PFI. Examples of PFI. So which are some of the examples of PFI? Examples of PFI. Examples of PFI. So number one, projected cash flow statement forecast. Projected cash flow statement forecast. Projected cash flow statement forecast. The number two, projected income and expenditure account. Projected income and expenditure account. Projected income and expenditure account. The number three, projected earnings of an entity. Projected earnings of an entity. Projected earnings of an entity. The number four, projected statement of financial position. Projected statement of financial position. Projected statement of financial position. The number five, capital budget in respect of fixed assets. Capital budget in respect of fixed assets. Capital budgets in respect of fixed assets. So then later down, we can look at the uses of PFI. 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 So one is so they can be used internally. They can be used internally or externally. They can be used internally or externally. They can be used internally or externally. E.g., an annual report, an annual report, an annual report to the shareholders, an annual report to the shareholders, an annual report to the shareholders, or an internal management tool, an internal management tool, so as to identify, future capital requirements, 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 or even by potential investors, or even by potential investors, or even by potential investors. The number 2 for loan, a loan application to a bank, loan application to a bank. So they can be used for loan application to a bank, a loan application to a bank, so as to support the application, a loan application to the bank, so as to support the applications. The bank may call for those statements to be examined by an independent auditor, and give out their assurance, So sana sana, the cash flow forecast. The cash flow forecast that could be required by the bank, but must have been what? Subject to examination by the auditor. And the auditor certified such kind of a document by providing a negative assurance. Okay, then there is the principles of PFI. The principles of PFI. Principles of PFI. Principles of PFI. Principles of PFI. So these are the guidelines when it comes to the preparation of this information. So one is that it must be there must be understandability. Yeah, so the users should be given all the sufficient information. The user should be provided with all sufficient information to facilitate their understandability. Next one is a relevance. Number 2, relevance. The relevance principle. Relevance principle. Yeah, so those information ought to be relevant to the users. Number 3, reliability. Yes, the facts, the estimates needs to be reliable. Next is a comparability. Number 4, comparability. If they can be compared from maybe one entity to another, or from one business to another. Then the last one is the presentation of PFI. Presentation of PFI. So the right format is to be used. Presentation of PFI. The right format needs to be used. The right format needs to be used. Like that PFI is required by the bank for loan application. The bank can give a prescribed format. The prescribed format for the preparation of the PFI. The bank can provide that prescribed format for the PFI preparation. So we can also have a summary of this. Matters considered by auditors. 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 So which are some of the essential matters that auditors will consider? Matters considered by auditors. Matters considered by auditors. So what is the purpose of the information? Number one, purpose of the information. Purpose of the information. Purpose of the information that has to be considered by the auditor. What is the information for? Number two, maintenance of confidentiality. Maintenance of confidentiality. Maintenance of confidentiality. So it's very important for the auditor to discuss with the client the extent on which the confidentiality shall be maintained. To what extent will the client be able to protect and safeguard such kind of information under the review? The next, the extent of distribution of PFI. Extent of distribution of PFI. Extent of distribution of PFI. That's put for the liability reasons. Liability reasons, so that it becomes very clear on which parties can maybe sue the auditor for liability claims. So they must specify which third parties can use the PFI, and if they use the PFI, which part of the segment of the report are they supposed to depend on in their decision-making process. The other one is the type of the report to be issued. The type of the report to be issued. The type of the report to be issued. In this case, that report will have what? A moderate level assurance, a moderate level assurance, or a limited assurance. The other one is the types of assumptions made in the PFI. Types of the assumptions made in the PFI. Types of the assumptions made in the PFI. So as the auditor, you need to check whether those particular hypothetical assumptions or the estimates are reasonable. You must also maybe check the risk and the implications involved, etc. The other is the time covered by the PFI. The time covered by the PFI. The time covered by the PFI. Is it 1 year? Is it 5 years? Or how many years of the projections? Next, the nature of the information in terms of technicality. Nature of information in terms of technicality. Nature of the information in terms of technicality. That one has to be considered to avoid any possible misunderstanding that may arise. To avoid any possible misunderstanding that may arise. To avoid any possible misunderstanding that may arise. The next, the competence of the audit firm. Competence of the audit firm. Competence of the audit firm is you must assess whether they have the capacity and capability to do the job. Do they have the capacity and the capability to do the job in terms of the resources, e.g. relevant skills, experience, enough personnel, etc. The other one is the details of the preparer of the PFI. 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 Details of the preparer of PFI. You need to ascertain whether they have relevant skills, the experience, the competency required when it comes to preparing such information. Are they qualified? They have the required competencies to be able to prepare such kind of information. So I think that's all on the PFI. That's all that you need to know on that part of prospective financial information. So check April 2023. April 2023, question number 3. 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 So let me read that question. April 2023, question 3. You are the manager in charge of the audit of Maridadi Fashions Limited, a private company dealing in the import and the sale of fashion wear. The company plans to seek a public quotation for its shares and is required to prepare prospectus, which must incorporate a report by the auditors of the company. The directors intend to include a profit forecast in the prospectus. You are approached by the Securities Exchange to report on the basis and calculation for the forecast. So required, A, explain the preliminary consideration that you will take into account before you accept responsibility for reporting on the profit forecast. B, discuss the specific audit procedures that you will perform to ensure that the profit forecast is not misleading. Then E, describe the matters that you will include in your report. So let's begin with the part A. Explain the preliminary consideration that you take into account before you accept responsibility for reporting on the profit forecast. So what matters will you consider before you accept that job, before you accept that work? So what will you consider before you say yes, you want to be given that job? So what will you consider? So point number one, is the exact components, of the prospective financial information, the exact components of the prospective financial information, the exact components of the PFI. Number two, you'll consider the form of the assurance report required, the form of the assurance report required, the form of the assurance report required. The other one, you'll consider the intended recipient of the report, intended recipient of the report, intended recipient of the report. Next, you will also consider liability, so limiting liability. You will also consider deadlines. You will consider also availability of evidence. You will also consider professional regulation, i.e. ISAE 3,400. ISAE 3,400 requirements. ISAE 3,400 requirements. You will also consider engagement administration, e.g. fee, the personnel, etc. Engagement administration, e.g. fee, the personnel, etc. So that question, what you just to identify those matters to be considered. That question was 6 marks, so give us 6 matters there to earn the 6 marks. Then you go to part B, discuss the specific audit procedures that you'll perform to ensure that the profit forecast is not misleading. So what are the specific procedures are you going to undertake to ensure that the profit forecast is not misleading? The profit forecast is not misleading. So which procedures will you undertake? We have got a number of those procedures that you will do with regard to the profit forecast. So one now, verify projected income figures. Verify projected income figures to suitable evidence. Verify projected income figures to suitable evidence. Verify projected income figures to suitable evidence. Yes, you can do the comparison there on those projections against maybe the existing projects. The other one, review current market prices for the product or service offered. Review the current market prices for the product or service offered. In this case, the sale of the fashion wear. Yeah, so we shall do the review of the current market prices for the fashion wear. We shall do the review of the current market prices for the fashion wear. Next, verify projected expenditure figures to suitable evidence. Verify projected expenditure figures to suitable evidence. Verify projected expenditure figures to suitable evidence. To suitable evidence. And next, you can also say that obtain management representation. Obtain management representation. Obtain management representation with respect to profit forecast. Obtain management representation with respect to profit forecast. The other one, compare the interest rates. Compare the interest rate assumption with the current bank rates. Compare the interest rates assumptions with the current bank rates. Next, do an inspection to check the market rate prices. Do an inspection to check market rate prices. For example, for advertising. For example, for advertising. For example, for advertising. And next, identify and document internal controls. Identify and document internal controls over the business processes. Identify and document internal controls over the business processes. And next, review whether the PFI on profit forecast, review whether the PFI on profit forecast is consistent with the basis of historical financial statements. Is consistent with the basic of historical financial statements. Is consistent with the basic of historical financial statements. Then we cannot go to part C of the question. Part C of the question. Describe the matters that you would include in your report. Discuss the matters that you would include in your report. Discuss the matters you would include in your report. So which matters will you put in your report? Which matters will you put in your report? So one is the level of assurance. Number one, level of assurance will appear in that report. Level of assurance. Number two, assumptions. Assumptions. Number three, reporting framework. Reporting framework. Number four, risk. Risk matter in terms of the PFI decisions. Then last one, disclaimer. Last one, disclaimer. There should be a disclaimer And that one is to put a warning to the users, putting a warning to the users that that report will only be used for that particular context. That report shall only be used for that particular context, or for only the agreed procedures, only in line with the agreed procedures results. So those are the matters that will be included in that report. Or maybe the last one, check May 2021. May 2021. May 2021, question number 2A. 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 Is on page 22. Page 22. So let me read. In an engagement to examine prospective financial information, the auditor should obtain sufficient and appropriate evidence as to whether management-based estimates, assumptions on which the prospective financial information is based are not unreasonable, and in the case of hypothetical assumption, such assumptions are consistent with the purpose of the information. So required. In the context of the above statement, number one, explore the difference between a forecast and a projection with reference to prospective financial information. Two, explain the matter you would consider before accepting an engagement to examine prospective financial information. Three, describe in detail the key areas of focus during the actual audit of prospective financial information. So let's now begin with the part one. Explore the difference between forecast and a projection with reference to prospective financial information. With respect to prospective financial information. What's the difference between a projection and a forecast? What's the difference between a projection and a forecast? So let's write the following that A forecast is a prospective financial information. A forecast is a prospective financial information. A forecast is a prospective financial information which is prepared on the basis of the future, on the basis of the future, on the basis of the future, which the management expects, which the management expects to take place, to take place, to take place, and the action which will be taken by the management, and the action which will be taken by the management, and the action will be taken by the management, and the action will be taken by the management. Such a document is based, such a document is based, such a document is based on the best estimates. Such a document is based on the best estimates or assumptions, on the best estimates or assumptions, and it is normally prepared, for a period of less than 1 year, for a period of less than 1 year, for a period of less than 1 year, e.g. an operational budget, e.g. an operational budget, e.g. an operational budget. So a projection is a prospective financial information. A projection is a prospective financial information. A projection is a prospective financial information which is prepared for a period between 2 to 30 years. For a period between 2 to 30 years. For a period between 2 to 30 years. E.g. a strategic plan. E.g. a strategic plan. E.g. a strategic plan. A projection may include or contain the following. A projection may include or contain the following. A projection may include or contain the following. Number one, hypothetical assumption. Hypothetical assumptions. Hypothetical assumptions. Hypothetical assumptions. Hypothetical assumptions. Hypothetical assumptions. These are the assumptions about future events. These are the assumptions about future events. These are the assumptions about future events. These are the assumptions about future events and actions, which management intends to take, which management intends to take, which management intends to take, which may or may not occur, which management intends to take, which may or may not occur, which may or may not occur. The number two matter, a mixture of best estimates, a mixture of best estimates, a mixture of best estimates, a mixture of best estimates and hypothetical assumptions, and hypothetical assumptions and hypothetical assumptions and hypothetical assumptions. So differences of forecast and a projection. The easiest one is just based on the time frame. A forecast less than a year, then projection between 2 to 30 years. It applies for long-term plans. Like if you have management level, if you have the management levels here, if you have got management level, this is the top level, this is the middle level, upper lower level. So the focus will apply at the lower level. The focus are applicable at a lower level. Then the projections are the top level. Projections are the top level. So they are prepared by the top level managers. They are prepared by the top level managers. They are prepared by the top level managers. Where the focus are prepared by the lower level managers. Focus are prepared by the lower level managers. Projections are used for what we call strategic plans. Projections are suitable for strategic plans. The strategic plans, while the focus are suitable for the operational plans. Operational plans like the annual budgets. For the operation plans like the annual budgets. Annual budgets. Time frame, this one, 0 to 1 year. Projections, 2 to 30 years. 2 to 30 years. 2 to 30 years. 2 to 30 years. Okay, let's go to part 2. We are not going through that. We discussed it in the other question in terms of the matters to consider before accepting the engagement. So not going to look at that question. Then part 3, describe in detail the key areas of focus during the actual audit of prospective financial information. So we are going to discuss in detail the key areas of focus. So which are the areas of focus? The other one we discussed in the other question, the profit forecast. So one is the profit forecast. Profit forecast. Number one is the profit forecast. Number 2, projected statement of financial position. 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 The other one is the projected earnings of an entity. Projected earnings of an entity. The other one is the projected cash flow statement forecast. Projected cash flow statement forecast. The other one is the capital budget in respect of fixed assets. Capital budget in respect of fixed assets. Capital budgets in respect of fixed assets. So let's bring that one to an end there. We'll move on to another subtopic. So our next subtopic is this part of due diligence review. The due diligence review. That's our next area. So let's have some few minutes break. So back on our due diligence. So, for example, any person wants to buy a company. Before making that decision, they really engage a professional or an expert to undertake a due diligence investigation and give them good information for support their decision making regarding any possible investments. So due diligence investigation is just a process of trying to obtain an evidence and assessing information relating to a particular transaction in order to identify the risk involved and the information. So the interested party on opportunities and the risk associated with the transaction. So there are quite a number of professionals which can be engaged to undertake a due diligence investigation. For example, the lawyers, the IT consultants, the tax consultants, professional accountants, etc. can be engaged in that process. So we want to look at this due diligence so that we understand what it entails, the nature of the work performed by the audit firm whenever they've been requested to undertake a due diligence investigation, then the matters that they will consider before accepting the due diligence investigation work, and what are the benefits and the challenges of the due diligence investigation. So we shall continue by looking at these particular notes here on the due diligence. The due diligence. So due diligence a review. So this is also just a type of a review engagement. The kind of assurance provided will be a limited or a negative opinion. So due diligence reviews are a specific type of a review engagement. A typical due diligence engagement is where an advisor, often an audit firm, is engaged by one company, plan to take over another, perform an assessment of the material risk associated with the transaction, including validating the assumptions underlying the purchase to ensure that the acquirer has all the necessary facts and that the perceived business opportunities are in fact real. This is important when determining purchase price. Similarly, due diligence can be requested by sellers. An accountant may be asked to perform due diligence review of the company, unit, or other assets as the case may be acquired in mergers and acquisition. The accountant So the accountant is supposed to identify risk, such as the risk of non-disclosure of any relevant information and non-disclosure of any liability. The accountant can review target companies and comment whether it's worth investing into these companies. Financial due diligence, a review of the financial position and obligation of a target to identify such as matters, covenants, and contingent obligations. Operational and IT due diligence, extent of operational and IT risk, including quality of the systems associated with the target business. People due diligence, key staff position under the new structure, contract termination cost, and the cost of its integration. Regulatory due diligence, review the target's level of compliance with the relevant regulation. Environmental due diligence, environmental health and safety, and social issues in a target. Matters to be considered before accepting a due diligence assignment. So one competency of the firm, the audit firm should have experience and skills to perform the review. Two, independence issue, as required in any assurance assignment. The accountant should be independent of both the parties. Three, sufficiency of resources, where the firm has adequate manpower to perform the engagement. Then 4, degree of confidentiality, who the assignment will be performed for and who will see the results. Next, the scope of the work, what areas are to be concentrated on. 6, the purpose of the acquisition, e.g., when the acquiring company is interested in acquiring the company, either share capital or its trading assets. This is because the auditor will accordingly concentrate his work in that particular area, if any. Then 7, planning due diligence assignment. With due diligence assignments, the scope of the work should be written down in the engagement letter and agreed to both the accountant and the client. The engagement letter should also include the following: the scope of the work, a clear demonstration of the responsibilities of the management and the accountant, a clarification of the interim report requirements, confidentiality. Apart from the usual consideration that the audit stock the review plan, a due diligence plan should include preparing a list of the required information and the people to be interviewed. In due diligence, the accountant analyzes the information supplied by the target company and interviews the member of the management of the target company. In order to do this more effectively, the required information and interviews should be identified well in advance and included in the plan. The target company needs to be informed well in advance about the required information and the interviews required so that the company can make the resources available. In a review engagement, the auditor will rely more heavily on procedures such as inquiry and analytical review than a more detailed substantive testing. So a typical due diligence review should include inquiries into structure, including how the target is owned and constituted and what changes will be necessary. Financial health based on a detailed examination of past financial statements and an analysis of the existing asset base. The other one, credibility of the owners, directors, and senior managers, including validation of the career histories of all the main players in the business, future potential reflected in the strength of its product or services, and the probability of earnings growth over the medium term to long term, assessment of the risk to the acquiring business in terms of their markets, strategy, and likely future events, the business plan in terms of how realistic it is, how solid the assumption used are, and how well it conveys the potential. The need of due diligence, so the purpose of the due diligence are reviewed. So one, before purchasing a company, it is crucial that the purchaser undertakes a comprehensive survey of the business in order to avoid any operational or financial surprises post-acquisition. Due diligence can simply be seen as a fact-finding and as a way to minimize the risk of making a bad investment. Two, investigative due diligence is the process by which the information is gathered about a target company for the purpose of ensuring that the acquirer has a full knowledge of the operation, financial performance and position, legal and tax situation, as well as general commercial background. Essentially, the aim is to uncover any skeletons in the closet and therefore to reveal any potential problem areas before a decision regarding the acquisition is made. Next, verification or specific management representation. The vendor may make representation to the potential acquirer, which it is essential to verify. The next, identification of the assets and liabilities. From an accounting perspective, it is crucial that all of the assets of the target company are identified. This is important because internally generated intangibles, such as customers, database, trade dress, and brand names are unlikely to be recognized in the individual company statement or financial position, a balance sheet, but should be identified and valued for the purposes of calculating goodwill on acquisition. As these assets are by definition without physical substance, only a detailed due diligence investigation will uncover them. As well as being important for the goodwill calculation, it's crucial to identify these assets as they represent hidden wealth within the target company and should be taken into account when negotiating the acquisition price. The next, the contingent liability must be identified, as the acquirer will need to understand the likelihood of the liability crystallizing and the potential financial consequences. The next, operational issues. One of the key benefits of the due diligence is to discover problems or risk within the entity. This risk may not necessarily arise in the context of the contingent liability, but could instead be operational issues such as the high staff turnover or the need to renegotiate contract terms with the suppliers or customers. The directors of the acquiring company will need to carefully consider whether such matters constitute deal breakers, in which case the investment will be considered too risky and so will not go ahead. Alternatively, the risk uncovered could be useful in negotiation to reduce the consideration paid, or the target company could be asked to provide assurance that these problems will be resolved pre-acquisition. Then acquisition planning. The due diligence investigation will also assess the commercial benefits and potential drawbacks of the acquisition. On the positive side, it will highlight matters such as expected operational synergies to be created post-acquisition and potential economies of scale to be exploited. On the downside, there will be acquisition expenses to pay, cost in terms of reorganization, and possible redundancy, as well as the important but hard to quantify issue of change management. Diligence provider may be able to offer recommendation as the best way to integrate the new company into the group. Then credibility. An external investigation also provide an independent, impartial view on the situation, enhancing the credibility of the investment decision and the amount paid for the investment. Took on the scope of the due diligence assignment compared to audit. When conducting a due diligence assignment, the scope is focused, as discussed above, primarily on the fact finding. This means that although the most recent set of financial statements will form a crucial source of information, the investigation will draw on a wider range of sources of information, including several years prior financial statements, management accounts, profit and cash flows forecast, any business plans recently prepared, discussion with the management, employees, and third parties. The aim of due diligence, in contrast to audit, is not to provide assurance that financial data is free from material misstatement, but rather to provide the acquirer with a set of information that has been reviewed. Consequently, no detailed audit procedures will be performed unless there are specific issues which either cause concern or have been specifically selected for further verification. For example, the acquirer may specifically request that the due diligence exercise provides an estimate of the valuation of the acquired intangible assets as discussed above. The type of the work performed will therefore be quite different, as due diligence investigation will primarily use analytical procedure as a means of gathering information. Very few, if any, substantive procedures will be carried out unless they have been specifically requested by the client. So due diligence is much more forward-looking than an audit. Much of the time during a due diligence investigation will be spent assessing forecasts and predictions. In comparison, audit procedures only tend to cover future events if they are directly relevant to the year-end financial statement. For example, contingency or going concern problems. In contrast to an audit, when it is essential to evaluate systems and controls, the due diligence investigation will not conduct detailed testing of the accounting and internal control system unless specifically requested to do so. So differences between due diligence and audit. So requirements: year-end audits are legally required for limited companies exceed the minimum audit threshold. They are also subject to strict regulation in the guise of the international standards of auditing. Due diligence is initiated at the request of the directors and subject to fewer prescribed rules. An outline of the process that should be followed can be found in ISR 2400, engagements to review financial statements, ISRS 4400, engagement to perform agreed upon procedures regarding financial information, A.A.A. E 3400, the examination prospective financial information, and ISAE 100, assurance engagements. The next audience: an audit opinion is offered to the shareholders of the business subject to audit. In contrast, the report from due diligence engagement are provided to the directors of the company. Then form of assurance. The opinion offered in an audit is one of the reasonable assurance. This means that sufficient appropriate evidence has been gathered to support an opinion as to whether the accounts are free from material misstatements. On the other hand, absolute assurance cannot be given for reasons such as the use of the accounting estimates, the nature of the fraud, how it is hidden, and the necessary use of the auditor sampling. As the timescale for a due diligence review is often relatively short, but wider in scope, clients may not always request the expression of an opinion. However, the accountant will be engaged to report upon certain criteria requested specifically by the client. If sought, the assurance offered will be limited assurance. Then the wording of the opinion. In the audit report, a positive statement of opinion is offered as whether the accounts are or are not a true and fair representation of the position and performance of the business under scrutiny. In a limited assurance report, a negative statement of opinion is given. This indicates whether anything has come to light during the review to indicate departure from the criteria initially agreed with the client. The next evidence: during an audit, evidence is usually gathered using a mixture of analytical review, inquiry, inspection of documentation, observation of procedures, and recomputation of certain balances. During due diligence, evidence is restricted, at least initially, to analytical review and inquiry. Further corroborative evidence might be sought if any material concerns were identified. Then due diligence conclusion. Due diligence is a specific example of direct reporting, assurance, engagement. It's agreed upon procedure The form the report issued in this type of engagement is covered by ISAE 3000 assurance engagement other than audits on review of historical financial information and ISRE 2400 engagements to review historical financial statements also contains relevant guidance. Okay, I think the main difference is there have been mentioned earlier, so there's no need for us again to repeat ourselves in that part. So that's all on the due diligence and exercise done to minimize any financial risk when it comes to making important business decisions. And a very good example in area of takeovers. I'll check a question on December 2021. December 2021. December 2021, question 5B. December 2021, question 5B. December 2021, question 5B. December 2021, question 5B. Question 5B. So we shall end there. Then when we meet in our next lesson, we shall begin from that part by looking at a question. So there are some few areas still remaining, the social and environmental audits. Now the last one should be integrated accounting. Integrated accounting that was missing in this handout here, but we shall add. These areas again we had covered in the other topic. These are the areas we had covered in the other topic. Things to do the IT controls, IT controls. IT controls. So let's end there. Then we meet next time, which is on next week, Friday.
Have a good day, Malim.
So you too.